the market in many ways looks more dangerous than it did even in 1999, 2000, and that was a bigger bubble than 1929. So that should really get people's attention.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. One of the great David Bowie's most popular songs was titled Changes. Today's guest, David Hay, Chief Investment Officer and Principal at Evergreen Gavekal, might well steal that title for his expected theme for 2025. He sees headwinds that could cause the economy to grow slower than many currently expect. He sees the prices of stocks and bonds at risk, the Fed increasingly behind the curve, the dollar potentially reversing, and lots of uncertainty to soon ensue as the Trump administration starts to deploy its disruptive policies. He'll walk us through charts of all of that and more today. David, thanks so much for joining us today.
It's a pleasure to be here again, Adam. And first of all, I want to wish you a happy new year, and I hope that this year is as prosperous for you as last year was. Your show, your channel is just doing fantastically well. I know you hear that from a lot of your guests, but it's true. And so kudos to you, and I hope that momentum keeps going.
You're very, very kind. Thank you very much. Happy New Year right back at you, as well as kudos to you for the performance of Evergreen Gavekal. I know you guys had a good year last year and a very good year, I believe, on your fixed income side of the house. So again, Mutual Appreciation Society, you're doing great things, and very happy to have you as one of the first guests here on Thoughtful Money for 2025.
Well, I will say this is not false humility. This is just reality that when you think about a really good year in the bond market last year, we were at about 4% return, which, you might think that's not that great, but it's about 4 times what the benchmark did. And I think that puts us in the top, close to the top percentile. So yeah, it's funny. The bond market is, of course, it's been struggling. We're going to talk about that more, but anyway, there's plenty to talk about. I do think we're in a pivotal period right now in the markets.
All right, so I was appropriate there with the David Bowie reference.
Very appropriate.
Okay, good. All right, well, look, I normally kick these interviews off with a very intentionally broad question to kind of get the discussion flowing. That question obviously is, what's your current assessment of the global economy and financial markets? David, being the far end of the curve student that he is, anticipated that question, put together actually a pretty phenomenal presentation. So David, I think maybe we address that question however you like, but do so maybe through your charts.
Well, before we get there, thank you. We'll definitely do that, and I appreciate that comment. Sometimes I'm guilty of over-engineering, and I think when I'm with you, I do that even more, and as my team members would, I'm sure, wholeheartedly agree. But to answer your basic point about the outlook for global financial markets and the economy, I would just say that probably a great word is precarious. I think there's really a major change going on right now. I mean, getting back to your opening theme of changes, and it has to do with liquidity. And I think those of us who are older, we've seen more tough market cycles than the younger people. We tend to be more value focused. I think we've really underestimated the impact of liquidity in recent years. In fact, the older I get, I think that's kind of like the number one thing. If you get the liquidity trends right, kind of everything else falls into place. And that's not to say that you ignore valuations or you ignore sentiment. I mean, those all matter. But I think in terms of the near-term direction of the market, liquidity is kind of it. And that's where I think there is a major shift going on. We do study and track a number of very good sources that are on top of liquidity much better than we are at Evergreen. And I think you just interviewed Darius Dale. I'm pretty sure I saw that hit my inbox here earlier today. And Darius has been very successful with his liquidity, kind of his defining, if you will. And because of you, I'm now a subscriber of 42 Macro, his company, a service, and he's clearly shifting gears and becoming more apprehensive. I don't think it's fair, and having just talked to him, you can correct me, but I don't think he's bearish, but I think he's definitely more cautious. Is that fair to say?
That is exactly true. In fact, the intro to the video that you're referencing, which just launched a few hours before we're sitting down here, Darius says, here at the start of 2025, I consider myself a cautious bull, but I think the odds are better than not that I'm going to become a raging bear later on in 2025.
Yeah, raging bear, hard to imagine that with Darius, but he's shown over the years a willingness to shift with the and when the tides change. And so I think that's an important data point. I also think Michael Howell, who I know you've had on, I
Hmm.
just saw a chart of his that looks like it's definitely becoming much more negative in terms of a liquidity drain. And I think you saw one that we ran here recently, which was from, not us, it was from, I'm trying to remember where we got it, maybe Michael Sembelis, but it was talking about the maturity wall that's coming in the corporate bond market starting this year. And so that's really, I think, an important point is that a lot of corporate America, unlike U.S. government, the U.S. government, termed out its debt back, 4 or 5 years ago during COVID when rates collapsed. And given the nature of corporate bonds, which don't run that long, they're relatively short term, a lot of them are starting to mature. So they're going to have to refinance at a much, much higher rate. Then I also, to give another shout out, we track the work of the Brogans at Wellington Shields, and their whole specialty is money flows. And starting about November, right around the time a lot of stocks topped out, they began flashing the red light on money flows. So I think just when you look at the liquidity picture in general, it's becoming much more guarded.
So I very much appreciate you zeroing in on liquidity. By the way, I'll be interviewing Michael Howell next week, so I'll have a fresh update from him soon. And he was very concerned the last time I talked to him, which was a few months back, about really about he has these liquidity cycles that he projects that are multi-year, and the current one ends at around the end of 2025, based on his calculations. But kind of like throwing a ball up in the air, the impulse slows as you approach the apex. So the upwards lifting force that rising liquidity has on asset prices begins to diminish the closer you get to the apex, right? And then, of course, after the end of this year, his model is turning down south. The liquidity goes into contraction, and he thinks 2026, at least last time I talked to him, he was concerned 2026 could be a really pretty ugly year. 2025, when I talked to him last, he wasn't certain whether it was going to be a down year or not, but he thought it would be a disappointing year because it's not going to be nearly as easy in his minds as 23 and 24 were. But anyways, I'll get the fresh update on that in a week. But it's interesting. I think it was maybe a year and a half ago, as the Fed had hiked interest rates, and there was a lot of talk about the lag effect, which I certainly participated in a lot of. And we haven't seen the arrival of the lag effect the way that many people expected we would. And I think one of the big reasons for that has been liquidity. And Michael Howell was one of the very first people to switch bullish at the end of 2022. And he did because in his model, the capital flows switched from net negative to net positive, right? So I remember saying in exasperation about a year and a half ago, like, is it just all about liquidity? Like, are we kind of wasting a lot of our time by looking at all these other factors, and should we just be looking at liquidity? And nothing is that simple. But one of the questions that came out of me asking this was, if it is as important as many of us think it is, why is that not? Why is a chart of the latest liquidity measure not on the top page of the Wall Street Journal every day? Why is it not on the business news every night? It really is a metric that isn't really that widely monitored by at least the average retail investor.
No, I think that's true, and but I think there's a lot of different versions of liquidity definitions and interpretations. But I guess I would argue, and this is kind of the voice of experience, having been like you, wrong-footed, and like so many of us, because of this unusual situation where we've had so many economic alarm bells going off in recent years. Whether it's the yield curve or leading economic indicators, uh, lots of economic data that looked like it was in the process of rolling over. We actually had an earnings recession. We had for a while a tax revenue recession where government revenues went down. But what really changed in 2023, and I think it changed almost overnight, was the federal government's deficits. And I think that the federal government is the ultimate supplier of liquidity, especially when you look at it, as I know you do, from both a fiscal and monetary standpoint.
Right.
And as you've said, I've heard you say this many times, you had a situation there in 2022, 23, especially, where you had the Fed hitting the brakes and the federal government, the fiscal side, hitting the accelerator. Well, I think in hindsight, we now realize that the fiscal side was hitting the accelerator a lot harder than the Fed was hitting the brakes.
Right.
And
And sorry to interject, but even and I use that analogy often. And I remember talking to Lynn Alden. She early on called it. She said, "I think this fiscal accelerator is going to win out." But even the Fed's hitting the brakes wasn't really hitting the brakes as much as many of us thought, right? So while it was raising the policy rate, it was draining the reverse repo program, right? It was putting other programs like the BFTP out there. Like there were things that were going on the monetary side that actually were supportive of liquidity, even though everybody was just focused on the policy rate.
well, to your point, I think if you look back to December 23, that was really, I think, a time where things flexed because Powell had said, and you will remember this in early December, that they weren't even considering lowering interest rates. And then by mid-December, he's talking about how they're going to lower interest rates like overnight.
Yep.
And by early 2024, so just a few weeks later, the market started anticipating 7 Fed rate cuts, which when you think about it, that was an enormous amount of financial market easing that was occurring. And then you had, of course, the bank problems, the 3 big bank failures, which then created that, what was it, Bank Term Funding Program, and
Yep.
which basically was a major liquidity infusion into the banking system. And as you point out, the reverse repo program was very large and was drawn down. So you had, even on the monetary side, these countervailing forces. But on the fiscal side, just no question. And that's really when I said, I think we're going to have this expansion is going to continue into 2024. I was more ambivalent about the markets, bullish on some things, bearish on others. I was right and wrong, depending on what asset class. But basically, that was a major change from Powell. But gosh, he's becoming kind of the master flip-flopper. It's really hard to know what he really believes. And certainly, and we're going to talk about this, what the Fed has done here recently and how, frankly, it's backfired. But maybe we should just, because you've done a good lead into the economy. And so let's talk about the economy here for a bit and get to another indication that the winds are shifting. Because as you're aware, last week, this week the big data point was the inflation reading that came out yesterday, which was more benign than expected, and that triggered the big rally. But last week it was the jobs number, which actually came out stronger than expected. And it's those jobs numbers create a tremendous amount of focus when they are initially released. But the you probably were more aware of this than most people, that these revisions that happen, which are really much more closer to reality, have been
Hmm.
consistently down. Something like 23 out of the last 24 months have been down. And it's about a cumulative 700,000 jobs that have been wiped away, and yet that doesn't get any attention. And we're also seeing corporate bankruptcies rising steeply. And if we actually look at our first visual here, we'll see what's going on with consumer defaults, credit card defaults, which are actually going up, pretty substantially. And that is a difference from what we've seen in the past. There we go. And also, kind of related to this, you may have seen this, that the credit card debt, which had been going up substantially, all of a sudden has turned down in a big way. And kind of lost in the holidays was the fact that consumer confidence at the end of December really collapsed. Because prior to that, in the kind of the post-election euphoria, consumer confidence, small business confidence, all those things were soaring. So this is another sign that, maybe that some things are starting to really bite. Maybe our lag that we've been waiting for is now hitting. And it's hitting at a time when most people are extremely complacent. We'll talk about this maybe more in the stock market section, but cash levels are just unbelievably low, and
So,
allocations to bonds are extremely low as well. Sorry, go
so
ahead.
Dave, just to mention one thing, is a question which you can answer, anywhere in this presentation is, we do seem to have come out of COVID with this K-shaped recovery, and the lag effect may very well be alive and well in the bottom half of the K, right? And I think data points like this sort of show that, right? So I think a big outstanding question is how much can the upper end of the K, the shorter but much more affluent upper end of the K, keep the averages looking good?
Yeah, nobody knows. I mean, obviously, I think that that's highly reliant upon the equity market. I don't think the affluent are really feeling too euphoric about their real estate portfolio, especially if they have much exposure to commercial real estate or even apartments. So it's really the equity market or cryptos and the meme coins that have been a huge source of kind of overnight wealth creation. So anything that would imperil the equity markets, I think would imperil that upper part of the K, which has been up till now doing great. The other, we don't talk about this a lot, but I think another reason why the lag hasn't worked very well is because for that upper part of the K, these higher interest rates are actually beneficial. Whether you're a cash-rich corporation like Microsoft or you're just a high net worth individual, that's got a lot of money in quasi fixed income investments or just cash, and you were making nothing on that a few years ago. Now you're making 4 or 5%.
Right. It's a stimulus to the affluent at a time when their equity positions have been going up too. So they're getting a double barrel of goodness from the financial markets. Yeah.
Absolutely, absolutely a double win. And so now those short-term rates have come down a bit. We're going to talk about what the Fed did here recently, but the equity market is still pretty good. But there's an asterisk, and I think a change coming with that as well. But let's talk a little bit about inflation here because I do think that that has so much to do with what obviously goes on in the bond market, and the bond market tends to set the tune for so many things because it's the cost of capital. So, there's this idea that the Fed is going to get the inflation rate down to 2%. I mean, that's certainly their goal. The problem is, and I know you had Jim Bianco on here recently, and he was pointing out that the core inflation rate's been stuck at 3% or higher, and actually back in 2022, much higher for about 4 years. So it has not come down to the Fed's target. Now, what's helped them has been that commodity prices have been under a lot of pressure, though some are now starting to turn the other way, which I think is a little bit ominous. But I would say, and this is actually giving kudos to my friend Vincent Delouard, who has created this haircut inflation index, which basically just measures how much is a typical haircut in America going up. I don't know how he calculates it, but ironically, it's about 4.5%, which is very close to, as we show on this chart, what core services ex shelter is officially. And I always hear that, well, gee, don't worry about the industrial side of the economy because the consumer's 70% of the economy. But when it comes to inflation, people don't seem to use that same ratio. So I would argue that probably services inflation is more accurate. I know you talked to Rick Rule here recently. He thinks inflation rates run at more like 7.5. The
Hmm.
very intellectually formidable Felix Zulauf believes it's kind of in the 4 to 5% range. I think that's about right. I would kind of agree with that. But it's a heck of a lot higher than the Fed's 2% target. So I think that the Fed does have an inflation problem on its hands, and it's occurring at a time when the economy looks to be slowing down. Now, I think inflation is a very interesting topic when it comes to the economy because, as you know, real GDP is calculated, take nominal GDP less inflation, that gives you real GDP. So if inflation is being understated, as a lot of us think it is, then that means that real growth is being overstated. So let's just say the economy is growing at 6% nominal, which includes inflation, and inflation's really 4.5. Well, then, the real GDP is only about 1.5. It's not that
Hmm.
great, not that far above inflation. And I think that's why a lot of people are they look at these reports of how, buoyant the U.S. economy is, and they go, well, not for me.
The only thing I'll add to that, David, is two things. One, more than almost any other topic, I do still see, I see the most disagreement on where inflation's headed. Although I would say where it was kind of 50-50 maybe a month or so ago, I think it's maybe more the majority now is beginning to say they think inflation's going to be a prolonged issue, or at least it's going to take the Fed a lot longer than it's hoping to get inflation down to its target rate. The only thing I'll note is I just interviewed Richard Koo, who former central banker, worked at the Fed, was involved in the Plaza Accord back in the 80s. Really just a highly experienced central banker. And he is echoing your thoughts here, both in terms of sort of the general true range of inflation, as well as for a variety of really kind of interesting reasons, thinking the Fed is going to be really challenged to get that inflation rate under control in any sort of near-term time frame.
Well, yeah, if he's saying that, that's pretty impressive. And I think even if this is again another Powell flip-flop, because he said back, and I believe it was November, kind of late last year, that they weren't even paying attention to what Trump's policies were going to be. Now they seem to be very focused on
Yeah.
which makes sense. I mean, I think that's one of the mistakes the Fed made in 2021 and 2022 was not being aware of that enormous amount of fiscal stimulus that was hitting the economy. And now I think they've perhaps learned their lesson and they're saying, geez, if we get these huge tariff increases, if we get forced deportations of workers, these things really could be quite inflationary. And I know you've talked, well, you're doing this new service with our show with Stephanie Pomboy, and that's great. She's terrific. So that's kudos to you on doing that as well. But she's kind of, I mean, she's definitely thinks the economy is pretty soft. If I'm not misquoting her, I think that's pretty accurate. But she also thinks inflation is more resilient than some of the other, let's call them economic bears out there. So that is kind of a stagflationary interpretation. And it kind of fits within one of my overarching themes that we're in a decade more like the 1970s. And we're going to look at some visuals coming up that would indicate that. And I think Jim Bianco had a good point about that too. But let's not get too ahead of ourselves. But I think let's go to the Fed actually right now because that's love to talk about the Fed. Already doing that.
Sure. And as you're bringing it up, I'll just mention that for reasons that are pretty wonky, Richard Koo says that the Fed is actually more challenged than it's been in previous decades to get inflation under control. And I don't want to get too wrapped around the axle for the reasons why, folks. If you're interested, go watch the video. But basically, he said it has forced the Fed to be much more reactive, which is why you keep hearing the Fed say, well, we're going to be data dependent, right? And, this is where critics of the Fed who say the Fed, uh, drives by looking in the rearview mirror. He's basically saying that is more true now than even normal. So rather than having a framework and having a roadmap that it's sort of trying to guide the economy to, it's much more in reaction mode, which of course generally makes the Fed late and usually making the wrong decision at the wrong time.
Absolutely. I think that's a great lead into the chart that we've got coming up here, because really this has not happened. To the earlier reference I made to Jim Bianco and your great podcast with him a week or two ago. So this is looking at going all the way back to the 1970s, mid 70s. And of course, mid 70s is when the Fed really got in trouble with inflation. And what you can see here is that the yield on the 10-year Treasury, there was a period there in the mid 70s where as the Fed was, they were kind of in a hold steady type of mode, but then the interest rates took off on them. But I think Jim Bianco would say where they really got flummoxed was in early 1981 when they were cutting. I think he said they went from 20% to 16. I think you kind of see that on this chart here, the Fed funds
Mm-hmm.
rate, the white line, and 10-year Treasury yields went up in that period of time. And let's go to the next one because it's hard to see on the far right, but you can really, we zoomed in here and you can see what's happened since September. So here's a good example where the Fed, I think, overreacted to what was not that much bad data and certainly ignoring the tremendous amount of froth in the financial markets. They cut interest rates 100 basis points, starting in September. Well, what did that do to the long-term bond market? It went up in yield.
Mm-hmm.
And it went up in yield by 120 basis points as of a couple of days ago. We got a rally today because of, or yesterday because of the supposedly soft inflation number. So this is a very much of a backfire for the Fed. And it's really reminiscent of that period of the late 70s, mid to late 70s, or coming right out of that when Volcker was, driving interest rates to 20% on the prime rate. And that actually, even though the bond market sold off there for a while, it was even if you got treasuries at 15% or 14% instead of 15, you still made a killing. But it just shows that even with that time period when the Fed had been so restrictive and was just trying to gradually normalize, the bond market was hypersensitive. And so this is very different. This is like a bond market that is kind of losing its moorings and is losing its confidence that the Fed really knows what it's doing. And it's actually not just in the U.S. This has been happening. I mean, as you're well aware, what's going on in the U.K. is pretty similar to what happened in
Mm-hmm.
2022 that forced their prime minister Liz Truss out at that time. So we've got a bit of a bond market riot going on. I think he talked to Bill Fleckenstein recently, and he's been saying that's when he thinks the jig is up for the equity market, is when the bond markets really start to break down and yields up, that we're going to have trouble with stocks.
Yeah, bonds will leak until stocks tank. That was his sort of pithy prediction for the year.
It's a good pithy prediction. And, then we've got the whole issue with Powell and Trump. And, Trump is making noises about appointing a shadow chairman. I really doubt he's going to replace Powell. I think Powell's term is up in April or May of 2026, so just a little over a year from now. But he can make his life pretty miserable between now and then. And that's something that Donald Trump seems to enjoy doing to anybody that doesn't march to his tune. And as you know, they got at cross purposes back in Trump's first term. So let's go and look a little bit more closely at the bond market, which, frankly, as I kind of alluded to, it's a global ugly fest, but with one exception, and that's China. But if we just stay focused on the U.S., I mean, when you look at this chart, which goes all the way back to 1990, and it's hard to believe that Treasury rates in the early 90s were at 9%, and then this long, long down channel that troughed out at about 55 basis points, a little over 0.5% on the 10-year Treasury. The 30-year was a little higher than that in the summer of 20 when it bottomed. And that's really when I became, after almost always being a bull on bonds since the early 80s, really became quite apprehensive and quite negative that we were going to see sharply rising rates, which in hindsight seems like, well, kind of duh. But at the time, it was not widely accepted that that would be the case because that trend had been so persistently down. So I think we're in the midst of a major bond bear market, but I do think that after the sell-off that we've had here recently, that we could get a rally, and particularly if something breaks either in the economy or the equity market or both. And I think that would trigger what Jeff Gundlach, and this is another double line slide. Jeff Gundlach is the head guy at Double Line, brilliant, brilliant man. So I want to give a shout out to him too. But he thinks we will get this, what he calls Pavlovian bond market rally, where you get something really bad that happens and bond yields go down. But as he's the first to admit, and I have said many times, I totally agree, obviously, the problem is what happens next.
Right.
So let's say you do get an actual recession, federal deficits erupt. They're already terrible. They're already at, like depression levels, 6.5, 7% of GDP. What if they go to 10, 11, 12? What's that do to the bond market because of that just absolute deluge of supply that would occur? It's a pretty scary thought. I frankly hope we don't have to deal with it, but I'm afraid we will. Let's take a look at our next one. So this is, I think this is right on point with what Fleckenstein was saying. So I'm old enough. I started in the business in 1979, believe it or not, which is when Volcker was first appointed under Jimmy Carter. May they both rest in peace. I think a lot of people think it was Reagan that appointed Volcker, but it was actually Jimmy Carter. But by 1987, when Volcker actually resigned, interest rates were screaming, and the stock market was screaming too. And as you can see on this, the 10-year Treasury actually briefly hit 10% right before the crash of '87. Then the crash happens, and then yields, went down sharply. They went down even lower subsequent to this. This shows 886 being the bottom, but they went, I think, closer to 7 at the trough of that time period. But my point is the stock market ignored it for quite a while. Inflation back then was actually probably pretty similar to where it is right now. And of course, interest rates are much lower, but we have a lot more debt. So you could make the argument that 5% is the new 10%.
Right.
So that's why I think Bill Fleckenstein's right, that I think we're getting close to the pain point and the reversal point where the stock market will no longer ignore what's happening with bonds. Let's go to our next one. Okay, good lead into the stock market. This is from Albert Edwards. You probably saw this. This made the rounds here a few weeks ago from Societe Generale. And he's known as a perma bear, but he's a very logical guy. And his point is well taken, which is if you look at when corporate profits really took off, it was right after COVID. And what also really took off right after COVID, the federal deficit. So I think it's greatly overlooked, especially by Wall Street, that there is such a correlation between huge deficits and big profit surges. In fact, you probably know that's the Levy-Kalecki equation that goes back to something like 1908. And it's because with all that new money coming into the economy, the corporations don't have to subsidize, say, through higher wages. It's just like rocket fuel for their profits.
Right.
And I mean, some people believe, I get emails from, oh, well, you just don't understand. This is the new normal. It's going to always be this way. We're always going to run 6 to 7% deficits during good times. I don't believe it. I think this is going to end really badly at some point. Don't ask me when the point is, but I think perhaps the best heads up on that is when the liquidity situation does start to deteriorate, as it is clearly right now. Okay, let's go to our next. We've got a few on. So you know this, the risk premium. So this is basically just looking at the 10-year treasury yield versus the inverse of the PE, which sounds like a lot of math gobbledygook. But basically, to make it easy, if the PE is 20 and it's higher than that right now, the earnings yield is 5. It's the inverse of the PE. So really a pretty easy calculation. Actually, the PE is somewhere around 22, 23, which means that the earnings yield and the 10-year treasury are right on top of each other. That's very, very unusual, as we can see from this chart. The last time it happened was early 2000s, right before one of the worst bear markets in history. So that's another reason why I think you need to be on guard right now.
Right. And in a way for the average person to look at this is basically stocks should have a higher earning yields than bonds because they're riskier. And so investors want to be compensated for that risk. When their earning yields is below bonds, well, then you're basically holding more risk for less return, which is not what an investor wants to do.
Correct. Well said. Okay, let's go to the next. Okay, this is, of course, been why a lot of value managers are out of work these days. So we're going all the way back to the 2000, then we see when the tech bubble blew apart in 2000, what did great over the next 7, 8 years with the stocks that nobody wanted to own, which were the value stocks, energy, financials, pipelines, you name it. Anything that had a low multiple and all the very highly hyped and high multiple stocks got absolutely nuked. A lot of people, I think, forget that Amazon went down 90% in that early 2000s period. So now we're at a period that's even worse in terms of dislocations of growth outperforming value. And I would also point out it's not just value managers that are losing their jobs. It's if you look at short sellers, I mean, they're going the way of dodo birds.
Oh, yeah.
In fact, just yesterday, I'm sure you saw this Hindenburg, which just put out a very good 85-page takedown of a certain used car vendor. And it's very coincidental that that report comes out, and then right after that, he hangs up the head guy at Hindenburg hangs up.
Yeah.
Right. But regardless, I mean, it's had Jim Chanos, who was famous as a short seller, basically uncovered Enron. He's gone. So to me, this stuff is just, it's like so reminiscent of what happened in the late 90s, early 2000s when like Julian Robertson and his famous fund, Tiger Fund, collapsed. And I think he said afterwards that if he'd stayed in business just a few more weeks, they would have had one of their best years ever, and they would have gone on a multi-year roll. And all this stuff just is so much of an echo of what happened 25 years ago. But frankly, Adam, there aren't a lot of old guys like me that are out there that remember that. All they really have seen is just year after year after year of growth outperforming. But things do change.
Right. And when you cross that midline there, right, it's same story, just different labels, right? It was the FANG stocks. It was, I can't remember how many different, acronyms they had for this category. Of course, now it's the Magnificent Seven. But yeah, I mean, it's just everybody has piled into that trade. There's the famous Wall Street adage, when everybody's on the same side of the boat, something very different is likely to happen. I always like to remind people that extremes are called extremes for a reason, because they mathematically must mean revert. If it was the new normal, it wouldn't be called an extreme anymore. But of course, when those things last for as long as they have here, everybody gets used to them, right? It's recency bias, and that's
Exactly. I
one
was
of the
just going to
biggest
say
dangers
that.
in investing. Yeah.
Well said. Well, we want to give a shout out to David Rosenberg, who created this. And he's always quoting Bob Farrell. And Bob Farrell says it's like when all the experts agree, something else is going to happen. And he also said that, exponentially rising markets don't correct by going sideways. And I think that we're probably at a position like that. You look at all the strategists for this year, everybody's predicting an up market. The only people that really are on guard are some of the renegades, or those people that really are paying attention to their liquidity indicators and are now starting to become cautious. Okay, we had at least one more on the stock market here.
Okay. Actually, before you talk about this, just real quick, I want to ask you a
Sure.
question, which, given your position at Gavekal, you might be, very well positioned to answer, which is, you made the comment earlier, you can keep the chart up, it's good. But you made the comment earlier that, a lot of the old guard isn't left anymore, right? They've just been beaten down and they've been grinded out, right, by this relentless continued ascent of growth. and passive investing too, right? I mean, all you have to do is basically buy the index or the Mag 7 and you're fine, right? Um, so we don't have a lot of people left who know how to invest in value stocks, who know how to invest actively, right? So let's say you're right, and we do have a correction here, and it's not a sideways one. It's one that's more violent. Um, what does that portend for a financial industry where most of the players are going to be in totally unfamiliar territory, where they don't necessarily have the musculature for investing in that type of environment?
Well, I think the best way to answer that, rather than use my opinion, is to look back at what happened 25 years ago because it was so similar. And what it triggered was a massive, they call it the Great Rotation. So fund flow out of growth. And it was so intense that we actually use one of our equity strategies is called right cycle investing, and it studies mutual fund flows, and it basically positions against extreme mutual fund flows. So when there's a long, persistent, and considerable outflows, and the valuations correspond with that. So the valuations get really ground down, which they
Mhm.
usually do correspond. We go overweight. We actually started going overweight large cap growth in 2004. And for a couple of years, it really didn't do very well. But then we basically stayed overweight large cap growth in that strategy until 2022 or so. But it was, obviously one of the greatest bull market runs of all time for large cap growth. But it came after a horrendous period. And it was just like, well, back in 2006, 2007, you couldn't get people to touch tech stocks. They were like radioactive.
Right.
So these things go in cycles. And I do think what's going to happen is a massive fund shift away from growth vehicles toward value vehicles. It's pretty easy just to say, well, I'm going to put, I can buy a value ETF. I don't have to have a manager that's going to pick value stocks, and that's true. I think you do have to be very careful at this point with how many of these ETFs own overlapping securities.
Right.
I think you'll find a lot of these ETFs that you don't think are heavy in Apple, Microsoft, Tesla, as you say, the Mag 7s, and they are. Now, usually the value funds are not, but obviously the flows are not towards value; they're towards growth, and they're towards growth in a huge way. They're towards leveraged ETFs. There's a very interesting chart. I don't have it in here. I think Mike Green actually did this, who you mentioned earlier, and he's been very, very much cautioning about this, the brainless monster of passive investing. But where you look at these leverage ETFs and treat it like margin debt, and so if you do that, margin debt is like off the charts on the high side.
I
And of
know.
course, in the options market, these 0 days to expiration options, the riskiest options, are now 50% of total option activity. It's just this mosaic all fits together. I mean, this is one. I know that Howard Marks put out a piece here recently where he said it's a frothy market, but I don't think it's a bubble. Well, if he was short Carvana, I think he'd have a different view of whether it's a bubble or not. It sounds like I'm a little biased there. I am. But forgetting that, I mean, there's just so many examples. We're going to look toward the end here at crypto, and crypto is just another example. I mean, Bitcoin is now kind of a blue chip, and it's not Bitcoin that's driving the crypto market. But we'll talk about that one at the time is right. But did you want to
Well,
cover something else on this?
no, I think the only other thing is just we'll get at the very end of this to sort of the steps that you're taking at Evergreen Gavekal and any counsel you have about how to ride 2025 from an investing standpoint. But I'm curious to this potential trend shift from everything growth to value and more steady Eddie kind of companies. Is that something that you're already kind of pre-gaming out, wargaming out at your firm, so that if and when it does happen, you know how to recognize it, you know how you're going to play it, or will you just sort of figure it out when the trend starts changing?
Well, first of all, let me say, and you've heard me say this before, that I try to be careful and say that I'm selectively bullish and selectively bearish. I think it's really dangerous to say I'm just all bullish or all bearish. I mean,
Hmm.
usually there's always opportunities. And to that point, and somewhat answering your question, we do look at breakouts. We are very focused on multi-year range expansions, as Paul Tudor Jones calls them. We believe that the longer the range has been in place, the more meaningful the breakout. And if you look at financials, for example, which are clearly value stocks, they broke out, early last year. It was a very bullish signal, and they've done quite well, especially in an environment that's been kind of value hostile. So I think that's what you start to look for, those things which are either breaking a downtrend, that's kind of step one, or the more strident buy signal is when it's a true range expansion. And so we are seeing some of those. We were seeing a lot of them at one point last year, which was one reason why I was like, well, yeah, this Mag 7 thing's a little bit overdone, but there's a lot of sectors that are looking very interesting technically. Now, I'd say that that's changed. I mean, if you go and look at many of these classic bank stocks are different. Bank stocks have continued to go up, but most value areas started to really get hit at the end of November, right around Thanksgiving. So there was this big rally after the election, and
Right.
then it's been a pretty broad correction. It's almost reminiscent of what happened in the late 90s when value was in a bear market and growth was still going up. So yeah, there's always opportunities. At the end here, we'll talk about some of these areas where I think there's tremendous value and big gains to be made, but unfortunately, it's not where most people are putting their money.
All right. Well, I'm just going to make a quick plug here for your firm, which is, um, you know, looking at the current extremes that we're at right now. Um, you want to be leveraging the experience of somebody who has the understanding of history, knows what that playbook looks like. And even just in this presentation itself, David, you've referenced specifically so many other times in history where you've seen echoes of what we're seeing now. I just feel like it's not the time to be at a firm where the talent is, I'll say, so young that they're going to be figuring out this trend change on the fly versus the voice and knowledge base of an experienced advisor.
Thank you, Adam.
Hey,
Well, when it comes to me, I'm definitely experienced. Some people would say overexperienced.
I wouldn't. I wouldn't. I would
But
say
this
it's
this
all
is to your
all good
point. I mean,
experience, my friend.
when you look at this visual, to your point, I mean, this is I can remember, just to back up so vividly, and I was in constant arguments with some of my peers back in 2011, 2012, when there was one investment advisor was taking out very expensive commercials, literally daily, multiple times a day on CNBC, that you wanted to be overweight emerging markets because they're higher structural growth rates. You may remember that tagline.
Mhm.
Well, I was saying, but they're trading at expensive PEs relative. This is when you could buy, basically the top companies in the S&P 500 for 11, 12, 13 times earnings. And I'm talking about Apple and Microsoft. They were value stocks back in those days. And yet the emerging markets were the ones that were the darlings. So, what goes around comes around. And when you look at this visual and you see how much of the return is coming out of the United States versus these other markets, it's just so skewed. And it depends. There's different, there's lies, damn lies, and statistics, but most of the statistics I see is that the U.S. is now 70 to 75% of the global market cap. Just unbelievable.
So there's a meme that I posted on Twitter the other day, which I'll try to overlay on here when I edit this. But it's if you can imagine it, it's a elephant balancing on a beach ball. And I put the term global capital on the elephant, and the beach ball is U.S. equities, right? So basically, global capital is in U.S. equities to a greater extent than it ever has been, right? You just mentioned, I've seen different estimates, but you just mentioned 70%, right, of total global market cap. And then it zooms in and you see that the beach ball is being held up by these few ants, right? And so on the ants, I labeled them the Magnificent Seven, right? Which is you have, the whole world in on the US stock market. The whole US stock market is basically being determined by a very small number of stocks. I think the most concentrated few number of stocks ever in history. So it's sort of as these few stocks go, so go, the world from at least an equity investor standpoint.
So true. And, frankly, some of those Magnificent Seven are not reporting such magnificent results,
Right.
including Tesla, including Apple, including, well, Microsoft has still done well, but there's some evidence of slowdown. NVIDIA, it's been unbelievably strong, but even there's some indications that perhaps their sales are going to grow at a slower pace. And, that's part of the problem is when expectations get so high and you're used to a, 50% quarter over quarter growth rate in sales, and then all of a sudden it becomes 20 and then 10, which is still good, the stock gets clobbered. And people are like, well, what happened? They're still reporting good numbers. And that's the curse of great expectations.
Exactly. And when you have so much of the world basically all in the same trade, you know, a disappointment in one or two of these stocks can end up vaporizing potentially trillions in market cap very quickly.
Yeah, and I should say for any clients that are listening to this or will listen to this, that Evergreen does own a lot of these names I just mentioned, but we have been taking profits. And that's one of the things that I think has kept us growing, even though we tend to be more of a growth at a reasonable price. We're not strict value, we're not strict growth, and we do have growth strategy, we do have value, we have all kinds of different strategies, but this willingness to take profits into a tremendous bull market, but yet still maintain participation. Yeah, there's going to be a point where we're going to say we wish we got out of everything that like that, but I found that that's pretty hazardous to make that kind of a decision. And so anyway, I think that and by the way, for your people that would say, yeah, that makes sense, I just don't want to pay the tax, take a look at your IRA. Most of your investors that are listening to this do have IRAs where they've got, some of these big winners. And it's so much more tax efficient to realize those winners inside of the IRA versus your
Right.
personal account, especially if you're getting older like me and someday you're going to get a step up in basis. I hope it's not tomorrow. All
All
right,
right. Anything else on
we're
the
not
stock
quite,
market or?
yeah, we're getting close here. We're coming down to the end
Okay.
of the stock market here. We can fast forward through some of this.
No, it's all good. Take your time.
I mean, look at this. Consumer expectations of higher stock prices again from Jeff Gundlach's firm. It's coming down a bit, but I mean, that took out the 2000. So many things, the market in many ways looks more dangerous than it did even in 1999, 2000, and that was a bigger bubble than 1929. So that should really get people's attention. Okay. Energy. So now here's an area we're starting to get into where you could put money. And I just saw that energy allocation is something like 3%. And what I hear constantly, you probably have had some people on your show that have talked about this. I remember a year or so ago that you had me on and you had somebody with a completely opposite view. And I hear some of these people saying, well, there's such a glut of oil. Really? Well, this is Cushing, which is the main oil nexus in the United States. And it's just like scraping bottom. And if you look at overall oil inventories in the West, adjusted for all the SPR releases, they're extremely low. But you couldn't get anybody to buy. In fact, my buddy Trader Ferg said that oil was basically like anybody that was an oil investor felt like they were at a funeral. And as recently as December, well, as usual, oil's rallied whenever it gets really negative. It's up about 15% getting hit today, but still it's had a great rally. And I think that's where we've done in our newsletter, The Haymaker. I think we've done our best job is getting people to focus on oil when it's down and take profits when it's run, which we're actually saying right now, take some profits. It's been a big run. You may remember our natural gas pains one. I think you almost ran that in your macro pass. I think you did the
Mm-hmm.
fertilizer one instead, which did okay, but natural gas has just gone straight up from September, and a lot of these natural gas producers have been terrific. Some have lagged. And I think at this point, where it's more interesting is not so much gas or oil, those commodities, but these producers, which in many cases, it's like the rally never happened. So I think there's some real inefficiencies, which probably speaks to the fact that so few people are putting their money in this area. They're all chasing tech stocks and ignoring these things. So
Right. And Dave, where do you think, so I've heard opinions of uh, the opportunity, like, different opinions on where the opportunity lies in the energy space, especially the oil stocks. And, some have said, well, in a drill baby drill world, the producers actually kind of get hurt by that, right? Because they end up increasing supply so much that they can't charge as much for it. A, do you believe that? And B, the okay, then where people say to put your money is in, the service companies, right? The companies that are running the pipelines, the refineries, stuff like that. Does your firm have a strong opinion one way or the other of where the real opportunity lies?
yeah, absolutely. So I'm going to borrow a quote from Louis Gove, who said, if it's drill baby drill, nobody told the oil service companies. So I don't know if you have the ability to pull up a chart of Schlumberger, SLB. Actually, that's its name now, not SLB, but it's just been crushed with very little of a bounce back. So it's quite the secret to the industry if that's really what's happening. And I think it's going to be tough, frankly. I would say what I think is a more likely outcome, and you start looking at these geopolitical things that are going on, whether it's now the Ukraine drones going after some of the Russian energy assets. And what if Israel goes after Iranian oil asset? Iran is producing way over the quotas. You got a new administration coming in there who doesn't like Iran. Allegedly, according to the FBI, the Iranian leadership tried to assassinate Donald Trump. That doesn't tend to generate kind feelings, and I don't think he likes their government anyway. So I think cutting them off. So ideally, I think what you'd want to do is try to reduce the oil output of the bad actors and increase the oil output of the good people in the United States. And really, the only way to do that right away is with OPEC, where you hear some people say that OPEC is sitting on 5 million barrels a day of excess supply. I don't believe that. I think it's more like 2.5 million, but there's quite a bit. And so if there is a reduction from Russia and Russia's output is declining, that gets very little press. It's in a very much of a bear market, but Iran is way overproducing their quotas. The sanctions have been ignored. I don't think those sanctions are going to continue to be ignored. So I think that's an underappreciated positive for the oil market. But in general, I think you want to be focused on energy equities. There's a tremendous amount of value. There's some of these Canadian companies are even cheaper. And you may have noticed that there's been a change of leadership up there. Their former prime minister is now out of a job, and he was very anti-fossil fuels. And Canadian natural gas is way cheaper than U.S. natural gas. So plenty of opportunities out there. They're just not in the picked over areas.
All right. Yeah, in Canada, I don't think they've actually had the official changing of the guard yet. I think they're still trying to find the successor in the current Liberal Party, but it does seem that when an election is held, which is a little up in the air, but should be held at least by October, the conservative candidate is way ahead in the polls and is very much of sort of a drill baby drill politician in stark contrast to Trudeau.
Yeah, that's what we know for sure. Trudeau's out. Mark Carney comes in. He's pretty green oriented, but I think he's much more electable. It could be more of a horse race, but I think you're right. I think there is going to be a kind of a shift up there as there has been in the United States. All right, let's go to our next visual. So this is, talk about just shooting yourself in the foot. Look at Europe. Look at the energy costs that Europe has got relative to the United States.
Yeah.
No wonder Germany's industrial sector is in recession and getting hollowed out because as you know, what they've done is they've built their industrial complex on the back of cheap Russian energy, which is not available anymore. And they shut down their nuclear fleet. They reopened part of it and they're shutting it down again, which is just unbelievable. So the cost of energy in Europe relative to the US is way higher. This is basically saying about 4 times what it is. And this is from JP Morgan, Michael Semblist. Now, if you're going to talk about U.S. exceptionalism, I think this is something to focus on versus our, fiscal deficit goosed GDP growth rates. This is an enduring advantage that we have if we don't squander it. And I think the good news is, under the new administration, we probably won't squander it.
Yeah, it seems like they very much appreciate it on that thing too. And you probably heard my discussions with Doomberg. He very strongly believes, and I think many people as well do, that the AI race is going to be basically won on the back of plentiful, cheap energy. And we have a surfeit of that relative to the rest of the world, especially the big players. So again, strategically, big advantage for the US.
And Canada.
And Canada, exactly. Yep. If they can get their act together, which hopefully they will. Just on the Germany part, did you listen to the Twitter space or the X space between Elon Musk and Alice Weidel, the head of AfD in Germany?
I didn't listen to it. I heard about it. I mean, I saw some of the actually critical headlines, but tell me your interpretation. I'm curious.
Well, they spent a lot of time talking about exactly this, about Germany's just sort of backwards thinking in terms of how it has essentially dismantled the better parts of its energy programs and has put Germany basically in this position now where it has both supply issues and affordability issues around energy, and they're still not reversing course yet on policy. So it's from her perspective very much like watching the country intentionally hit itself in the face with a hammer.
Well, I have even a darker interpretation of that, which I've got some backup for saying this, including the former Secretary General of NATO. But there's almost no doubt that some of these extreme green movements in Europe have been heavily funded by the Russians, which makes total sense. I mean, get them to, if you look at domestic or European energy production, their own oil and gas production over the last 20 years, it's gone straight down. Until the invasion of Ukraine, their consumption of energy from Russia had gone straight up. So it put them in an incredibly vulnerable position. Actually, I don't agree with a lot of things Donald Trump says, but in this first term, he warned them of that repeatedly and vehemently, and they laughed at him literally. And he was right. So it's just incredible that given the experience of the last few years that they're still so anti, particularly nuclear, which a lot of Greens are starting to embrace, but not in Germany. So yeah, I
Yeah,
think
it's
they've got
funny that
real problems.
America is, who's been very, suspicious of nuclear for many decades, is now really getting on board, but Germany still, for some reason, hasn't gotten the memo when they had some of the best plants, in the world there. But anyways, sounds like long story short here, you're bullish about the prospects for the energy industry going forward, and you're bullish about America's prospects, or American Canada's prospects, strategically given their energy resources.
Well, yeah, and let me just put another bullish plug here. Again, there's a lot of opportunities because the market is very diverse and corrections happen in certain areas while others, continue to go up. So one area that's corrected really hard where the fundamentals are terrific is uranium. And uranium, I think, is going to be where the U.S. has an energy miracle. I don't think it's going to be fusion anytime in my lifetime, certainly, but next generation fission. And you're well aware that there's small modular reactors that are getting a lot of attention. They're actually not considered to be fourth generation reactors. That's more the molten salt technology, which is really getting ready for prime time. Now, a lot of people say, oh, it's still a decade away. I don't think so. I think it's a matter of a few years away. But regardless, the backdrop for uranium is so bullish, where the demand is being increasingly challenged. The largest producer is Kazatomprom from Kazakhstan. That's about 40% of global supply, and they keep cutting their output. So I don't want to go on a whole long diatribe here, but there is an ETF that you can buy that gives you exposure to uranium. It was trading at 25. It's back down around 17 or so. We've written it up a number of times in our newsletter. So I think that's a place that your listeners can make some money, maybe quite a bit of money over the next couple of years.
Okay, that was my next question, was the sort of timeline. So this is one that you think will have a tailwind measured in years behind it.
It measured in years, but I think it's going to work near term too. I think it's one of those nice times where you're looking at something in an uptrend that's corrected, and yet the underlying fundamentals are just outstandingly positive. And I don't use
Okay.
that lightly. It's actually Gearing and Rosenzweig, and you can get there, and your viewers can get that research very easily. It's free. They've got some great write-ups on the bullish story for uranium.
Okay.
All
And
right,
when you
let's.
talk, when
Oh,
you talk
sorry.
about the nuclear ETF, are you talking about just a uranium price ETF, or are you talking about an ETF that invests actually in nuclear projects?
It's a good question. It's so we because so many of these nuclear producers, like Cameco is the Microsoft of the nuclear energy world, and it's just very, very expensive. We made a lot of money on it a few years ago, sold it too early in full disclosure. But the rest of them are all startups. They're years away from profitability, and there's some interesting plays there, but they're very risky. I think unless you really want to roll the dice, you're better off just buying the uranium for
Okay.
now. But that's
All
kind of a
right.
chicken way
Sorry.
to play it. No, that's all right.
I
It's good.
keep derailing your momentum here just because you keep giving me the opportunity to ask so many interesting questions. But I do see from your
Derail
list
away.
here, you still have more slides. So let me let you
Well,
get
we
back to your plan.
I know we're coming up close to an hour here. We can fast track these here, but I
Okay.
just I like to focus on some of the bullish things because I get kind of pigeonholed as I'm bearish, even though in our newsletter every week I've got this long list of things that we like, and usually if we downgrade something, it's just to take partial profits, but that is something that we do, and again in writing you can see that where we get these big moves in our favor, take some off the table. And what I find most people is they put more in. Now, a lot of these people were, I can remember getting some emails about uranium when it was going nuts. Like, what are you? You're crazy to be saying take some profits on it. But these things, they inhale and they exhale. They don't just go straight up. All right, back to momentum.
Excellent.
Brazil. So here's a classic example. This is a country that everybody loved back in 2011, 2012. Nobody loves these days. The currency has been clobbered. They've got a left-wing politician in there who's quite elderly and is maybe losing his mental edge. I know that never happens to people that are 79 years old, but the currency has definitely been hit hard. And I will say, in fairness, if you look at this chart, it has had an upside breakout, which is actually negative when it comes to a currency. So it takes more reals, the Brazilian currency, to buy dollars than it used to. So it's quite possible that this is going to continue to go down as far as the currency goes. But when you look at the stock market and the bond market, it's just unbelievable. So if we go to the next one, you'll see where their interest rates are. So this looks like the U.S. under Volcker. We have down there, they have 15% 10-year government bond yields, and their inflation rate's 5. It's a carbon copy of where it was under Volcker. So this is not what we associate with emerging markets where we would expect the real interest rate to be negative. It is just a massively positive real rate. very hard for your listener, very hard even for us to buy Brazilian debt. You can buy it in dollars, but to buy it in the reals where you're going to get the best bang for your buck is very hard. But there are Brazilian equity ETFs out there where if the interest rates come down drastically, as they likely will at some point, you're going to get a huge move in the stocks. And the market down there is trading kind of in the 7.5, 8 times earnings range, which coincidentally is where the U.S. stock market was under Volcker in 1982 or 81, 82 before, the beginning of the biggest bull market in U.S. history. So I think you can make a lot of money in Brazil, but it's
Right.
riskier for sure. But I think
Yeah.
actually it's a lot less risky than the U.S. stock market right now.
Right. Well, those PEs you just mentioned are what, about a third that the
Yeah,
PERs are in the US?
right. And our rates may come down a little bit. Maybe we'll get that rally I was talking about from 5 to 4 or 5 to 3 3/4, something like that. But where you're going to get really a major decline in interest rates, which is what creates the huge PE tailwind, is in a country like Brazil. Okay. And it's just looking at their policy rate, basically their Fed funds rate. So it too is extremely high. And it reacted, I guess, kind of the point here. This is how quickly and forcefully they reacted to inflation accelerating while the Fed was asleep at the switch for so long. Again, this is very different than in the old days where emerging markets would be the ones that had the lax monetary policy and the US was the star kid or the very kind of Chicago school of economics. Let's keep inflation under taps, under
Yeah.
control. Okay,
Hey, one question on this. So,
sure. Any questions?
I was talking with uh, the great interviewer, Grant Williams, and
Oh yeah,
he
my buddy.
was your buddy, and he was saying that he thinks there's a lot of potential opportunity going forward in emerging markets, and there's some fundamental reasons for that. But I think it was even more like back to the whole price is what you pay, value is what you get. Like at some point, there's a price at which, under other circumstances, might not be a great investment, becomes a really good investment because it's just too undervalued relative to its intrinsic value. And
Sure.
I've talked to some guys from GMO, Jeremy Grantham's organization, and obviously they're pretty bullish on emerging markets as well. Um, and so, there's you just gave us sort of a good scenario there with Brazil specifically, but could some of these other areas, some emerging markets, maybe even some other corporate sectors, have kind of either pre-crashed or they're just so low value right now that even though you're worried about a larger correction of the major indices and some of the high-flying stocks like the Magnificent Seven, you may be able to buy in some of these really deep value opportunities now and have the potential to ride the appreciation you're talking about in the future, but also to be, much less vulnerable to a general market correction because these things are so cheap. They don't have that far to fall.
Yeah, it's hard to get hurt falling out of a one-story window, and it's even harder to get hurt when you're in the basement. So I think you're right. I think a good example of what you're talking about is Argentina, and I think that's very relevant to Brazil because they're obviously close geographically. And I wish I could tell you that I was pounding the table to buy Argentinian bonds and stocks a year ago, but I should have. And what Javier Milei has been able to do in Argentina is pretty stunning.
Oh,
And
it's stunning. Yeah.
there was a lot of skepticism even a few months ago that they said, well, yeah, he's getting inflation down, but it's killing the economy and he's going to be thrown out of office. But now it's almost kind of like what Reagan and Volcker did is now the inflation rate continues to fall and now the economy is recovering on top of it. My point is if even left-wing Brazilian politicians are going to look at that and go, well, maybe we need a little of that. Maybe we need a little budgetary discipline. And they're not anywhere near as bad a shape as Argentina was, pre-Malay, but a little bit of a, market-friendly budget down in Brazil, and I think you'll see those long-term interest rates go from, 15 to 12 really quickly and a big market rally too. But I think when you look at emerging markets, you want to look at undervalued currency, ideally, undervalued bond market, undervalued stock market, just kind of check the boxes, and some indication of fiscal and monetary responsibility. And I would argue that a lot of these emerging countries are actually doing better from the standpoint of fiscal and monetary discipline than the so-called rich world.
Yeah, yeah, I can't argue with that. And look, when you talk about undervalued currencies, that's probably a good segue into your next
Thank you.
title slide here, right?
Yes. Now this is a fascinating country because it's definitely not an emerging country, but its currency is being priced like one. So this is the famous Big Mac index. So it's like, what does a Big Mac cost in Tokyo, which used to be, of course, one of the most expensive cities for food, hotels, et cetera? Their tourism business is absolutely booming because their currency is so cheap that it's attracting, countless foreign visitors. I've talked to people, good friends that have been over there. Just Jesse Felder, who I know you've interviewed, he was on a family vacation last summer and just raved about how great it is. And
Yeah.
it's a modern
And
country,
how cheap. I think he told me he took his son
unbelievably
out for
cheap.
like a great steak dinner and it was like, you know, I don't know, under $100 for two guys to go and stuff themselves silly on the best steaks there. Yeah.
Yeah, that's such a good point because, boy, I'll tell you, in the US, it's just the opposite. You go to dinner and it's just so expensive these days. And I think that's why a lot of restaurants are starting to fail. That's a whole nother subject. But
Yep.
look at then if we go to the next one, look at what a Big Mac costs in the United States by comparison. 569. I mean, that's a huge difference. What is that? A 60 plus percent from the Big Mac in Japan to New York,
Hmm.
or I think it's just the average US city. I don't think it's even New York. So the Japanese yen is unbelievably undervalued and it needs a catalyst, but we're going to see one potentially coming up here in a bit. I mean, because they are raising rates and it's off of a very low level. But as you remember back in the summer, the out of the blue, because the Bank of Japan did hike rates and kind of surprise people, the yen had an explosive rally which triggered a very nasty sell-off in global markets and actually the Japanese market too. It went down 25%, but the Nasdaq went down 14% in a few days. That's kind of forgotten about. And it's because there's so many hedge funds, but even Warren Buffett, who borrow in yen because the yen has been such a low-cost source of funding, and then they invest overseas in other assets. But if the yen starts to really rise, then they get margin call, not Warren Buffett, but the highly leveraged hedge funds get margin calls, and then they're forced to sell, and it can be a really disastrous scenario. And now, will this repeat like it did in the summer? I don't know, but something's going to bring the yen up in value significantly. And I think it's a great thing for your folks to look at because you can, again, buy an ETF in yen that's very easy to acquire, and it's a good portfolio hedge. If people listen to this and go, yeah, I'd like to have, I don't really want to sell my Microsoft or my Mag 7 stocks, but I'd like to have some protection. I don't really want to buy puts because they expire. The yen is one where you can just kind of hold it until it moves. You don't get penalized other than you don't earn anything on it. But I think it's a great anti-fragile asset, and there aren't that many anti-fragile assets out there right now.
Okay. So sorry, just to make sure I heard correctly. Is this owning an ETF that tracks the yen, or
Yes.
is this okay?
Now, the other thing you can do, which I like a lot too, now the Japanese stock market has been very good, I mean, it's been outstanding in yen. It's been not so outstanding in US dollars because as the yen goes down, it lowers the returns for US investors, which is why I think Buffett hedged because he's got several large Japanese blue chips in his portfolio. But that market is still very cheap, more like 15, 16 times earnings and a whole bunch of companies that trade well below that. And the whole bull story in Japan, I think, is a multi-year one, and of course it's due. I mean, it was one of the biggest bubbles. Actually, it was the biggest equity bubble in history that crested in around 1990, then went to a 30-plus year bear market. So it's got a lot of catching up to do. But again, if you look at these trading range situations, the Nikkei, the Japanese stock market, had a major breakout here a couple of years ago. So when you break out of a 30 plus year downtrend, that's a big bullish signal.
Okay. So this is maybe a segue into your next topic here, but you say that the currency is silly cheap relative to the US dollar. US dollar has been strong, has been strengthening, and has had its own breakout recently above its multi-year trading range. Um, Presumably, and we'll get to your thoughts on the dollar in a second, but if the dollar were to start weakening, right, and there are some, folks that think as much as Trump, beats his chest about tariffs and other things like that, that he would prefer to have a weakening dollar over his administration because it will help in certain ways. If the yen started appreciating versus the dollar, that would also add to any Japanese stocks returns for American investors. That should also help, correct?
Exactly. So it's kind of what I was saying earlier about emerging markets, though Japan is not. It's very much of a developed country, is that you want to have an undervalued market with an undervalued currency. Now, you can't really say it's an undervalued bond market. So that could be the negative is that if their yields keep going up, that's going to work against multiples. But, yields are so low that even if they doubled, a 2% long government bond yield in Japan is not exactly a big wet blanket on the stock market. So yes, I think that's right. And I do think the dollar, yes, it's making a new all-time high against the real, but not against the yen, not against a lot of currencies. It actually hasn't taken out its peak from, I think it was 2022. I think we may have that chart coming up, but it hasn't quite had a multi-year breakout. It could be, but I think you're exactly right. Trump, the last thing he wants is a higher dollar. He wants that dollar down a lot.
All right. Well, let's use that as a way to get into the dollar discussion.
Well, this
Oh,
is what I
and
was saying earlier about
clean
yields,
up here. Yeah.
but this is a big chart. It's again, thank you, Jeff Gunlock here. We had one, but his is prettier. And it's just showing what this, I think very few investors, even professionally, are aware of this. So here we actually have Japanese long, this is 30-year bond. So very long-term yields in Japan higher than they are in China. That's dramatic. And that's another reason why I think you're going to see the yen rally. But it also, I think, speaks to how weak the Chinese economy is. I don't think their bond market being at these yields is a sign of strength. I think it's a sign of weakness. I think we have and this is where I think Louis Gav and I would diverge, is I think that China rather has a deflationary bust going on right now that is reminiscent of what happened to Japan 35 years ago.
So just as an FYI, and folks can get the details while watching the video, but when I talked to Richard Koo, we talked a fair amount about the balance sheet recession that he believes China is stuck in. He believes they're going to get out of it a lot faster than Japan did. And
Well, let's hope so.
yeah, and part of that is because the Japanese bubble was so colossal, but also it was the first to go through this, and so everybody's had the benefit of learning from that experience and figuring out policy-wise what can be done to get yourself out of there. So he feels pretty confident China's going to kind of dig itself out of the hole, but he said that's going to be a multi-year process. And when I sort of pressed him on it, he was like maybe 5-ish years. So it's not going to be. He would not expect China to come roaring back anytime soon. Put it that way.
Yeah, that said, I know we've talked about this before, and sometimes I'm right, sometimes I'm wrong, because I think right after I said this to you back in the summer, the Chinese stock market did rally, but it didn't hold that rally. There will be rallies. I think they're just kind of like
Sure.
the U.S. bond market. There will be trading rallies, but I think they're rallies to sell into, frankly. Just
Hmm.
like all those rallies that happened in Japan from 1990 on were selling rallies or selling opportunities.
Hmm.
So I would agree with what he said. I don't think it's going to be 30, 35 years for China. They've got a lot of dynamism in their economy, but they do have terrible demographics, and I also don't like their policies. I mean, that's unfortunately this Chairman Mao Act 2.0 has not played well.
Mm.
Okay, so I was saying this earlier, Bitcoin's become kind of the blue chip of the crypto world, and it's certainly had a terrific performance. And this is looking since the election. So just in that period of time, Bitcoin was up, what is it, 44% roughly. But Dogecoin, which is worthless, but it does have a very important backer in Elon Musk. He's got, I think he still has that dog. That's the Shiba Inu, whatever you say. That's the avatar for Dogecoin. So when the Trump administration won, and that's why Tesla has gone vertical too. It isn't the fundamentals; it's a sense that well now all the halo effect from the Trump administration is
Right.
now
It's
right
in
right on
favor with
top
the
of
new
Elon
power
Musk.
structure. Yeah.
Exactly. So there's not a lot of logic behind it. But then if you were to even look at the scatological, I won't say the name to gross out your viewers, listeners, but this meme coin that just came out that's gone up even more. I mean, this is, forget the stock market. This is where the absolute insane tulip bulb speculation is going on right now. And it's just amazing because in 2021, we had the same thing. It got absolutely nuked in 2022. So this is the area that I would be particularly leery of. And this is where you've really got a lot of unskilled amateur investors actively participating.
How short our memories are. Again, back to
Amazing.
the Richard Koo discussion. In talking about recovering from balance sheet recessions, one of the things Richard mentioned is it takes a good while to get out of one because everybody gets so burned. It's almost like what happened in the Depression, right? Where people go into sort of extreme saving mode. They focus on paying down debt, they focus on saving versus consumption and investment. And so you kind of have to heal balance sheets over time, but you also have to heal the psyche to get people to start being willing to take on risk again. Now, obviously, US is completely at the other end of the spectrum, right? I mean, just speculation is running rampant here. And I kind of pushed Mr. Koo on this that, America's had 3 massive bubbles in relatively recent living memory in the past 25 years, right? dot-com housing bubble and then everything bubble now. Um, where I'm going with this, David, is presumably, I imagine you think there's going to be some correction here, that the speculation can't last forever. Um, what sort of risk do you put, not necessarily on the next correction, but like, do you see this cycle of excessive speculation? Are we going to be stuck in that for the foreseeable future here over the next couple of decades? Or are we, you mentioned at the very beginning that you're sort of on this precipice. Are we potentially closer to a moment where there is such a painful correction that we actually change our behavior relative to speculation going forward?
Well, you would think at some point that's got to happen, but I think it's going to take a change in mindset among the powers that be, particularly at the Fed, because in so many ways they've been the ones that have provided the helium for these bubbles that have inflated. And if you went back to you brought up the technology bubble, and when the technology bubble popped, Alan Greenspan frankly panicked, and he was under a lot of pressure from people like Paul Krugman and some others that were actually more credible to create another bubble. He literally begged Alan Greenspan to create a bubble in housing, which he did. Now, I don't think Greenspan
Hmm.
meant to do it. He was probably trying to help it out, but it got out of control, and so we had bubble 2.0, which was housing, and then that blew apart, and then we did all the QE and then started running, huge deficits, not as huge as now. And so then we created, bubble, what I call 3.0, which was, you said, the everything bubble, which really, that one pretty much peaked out in 2021. And a lot of these really speculative, what I call them the crazy overpriced stocks, the cops, they went down 70, 80, 90% in 2022. But as to your point, there's like complete amnesia about that happening. And a lot of those cryptos, including Bitcoin, got absolutely crushed. I think Bitcoin was down something like 70% in 2022. So yet here we are again. So
Right.
I almost argue this is bubble 4.0. And it's like, when will the Fed learn that they can't just come to the rescue and just fire hose with trillions of dollars of liquidity every time the market hiccups? Now you could say, well, actually, Powell didn't do that in 2022, but as you already pointed out, there were these stealth liquidity injections. So I don't know. I don't know what's going to cause it to change. I think probably it's going to take a true riot in the sovereign bond markets, Western bond markets, where the Fed cuts, and like we looked at this earlier, the Fed cuts and the bond market goes down and yields go up. If that starts happening, if it becomes, if the Fed isn't able to manipulate, control the long bond market, because that's what drives housing, right? It's not the short rates, it's the long rates.
Right.
And housing is important. Autos are important. Now, those two markets, I think, are in trouble. I know there was a surge of auto sales at the end of the year because of expiring incentives, and tax credits, but I think both of those are in recession. So it's going to take a different mentality at the Fed, and I think you brought this up earlier and how the Fed has become so reactionary. I think the ultimate problem is it's become highly politicized, and it's not so much trying to please a party. I think it's just that there's so much groupthink, and if you don't fit within, you've interviewed Tom Honig, right? Thomas
Yeah.
Honig.
Yeah.
He was the dissenter. He's the one that
He was the
warned
lone
them,
dissenter. Yeah.
and they basically froze him out. And so if you don't think like everybody else, you kind of get kicked out of the club, and that's not what you need. And that's why they keep making such terrible decisions with their 400 whatever it is PhDs and all their computer software. And how can they can't even get they can't predict short-term interest rates, and they set short-term interest rates.
Right.
It's
You mentioned Tom Hennig. Uh, when I first interviewed him, I asked him what it was like to sit around that table at the FOMC, and I asked, is the Fed truly politically independent the way that it claims? And he said, well, I got to tell you, the two loudest voices at the table are Capitol Hill and Wall Street, right? And the voice that is not at the table is the American consumer. And to your point, I'm not necessarily, I don't necessarily believe in it's all planned and there's an Illuminati that's trying to run everything. But I think we kind of almost get the same thing just by the power players playing to their self-interests. And the people who have power, political power, they benefit from bailouts, right? They don't benefit by watching things get bad on their watch, right? That's how they lose elections and lose their positions. And the people who benefit most from central planning intervention you were talking about the Kalecki equation and showing how, higher deficits mean higher corporate profits, right? So you got all of corporate America who is funding, all the lobbying to Wall Street, to Capitol Hill. They all want intervention. So it's kind of like everybody wants intervention. And now that we opened the genie's bottle of sending checks directly to households during times of economic strife, you can pretty much bet the populace is going to beg for intervention the next time we have a recession here. So, I kind of asked this question. It's a little bit rhetorical, but I really like your answer. But I think the answer is that old expression, after a cat jumps on a hot stove, it's not going to jump on a hot stove again, but it's not going to jump on any stove again, right? And
Mark
it's
Twain.
probably going to take something super painful to finally change that mindset. But sadly, I think it's going to have to be really, really painful to break this addiction we have to these speculation-driven cycles.
Yeah, well, I'm going to stick my neck out again like Marie Antoinette. I'm good at that. Is that I think that extreme pain is going to come from the bond market.
Hmm.
And you get long rates at 6 to 7%, particularly in a bad economy or a slowing economy or recessionary economy. That's going to be like unbelievably disturbing to the power structure. They're going to go, wow, because that's how they have to fund themselves, and especially since Janet Yellen, as you well know, has got the maturity profile so short term. So it's heavily funded by T-bills that roll over all the time. So if the bond market gets away from them, which I think it will, watch out. Because then the Fed tries to monetize and then rates go up even more because it's so inflationary. So I think we've played a lot of these easy games and now the really hard games are up ahead.
Right. And our debt service it gets even worse too, as the government is forced to refinance at higher yields.
Now there will be
Um,
solutions. Don't get me
sorry,
wrong.
go
I
ahead.
think there's definitely things that America can do to get out of this situation. There's definitely solutions. So don't get me wrong. I think there's definitely things we can do to get out of this, but we're not even close to implementing them.
All right. Well, David, I hate to say this. I'm looking at the time. We can still go a
Yep,
little bit longer, but I want to
we
give you
better
the
go.
chance to start wrapping things up in however much you want to, or however you want to put a bow on this.
Well, here, just let's look at this dollar chart just to show what I was. So it's true the dollar's broken out over the last couple of years, but it's still well below where it was in 2022. So I don't think we're in a new bull market. I think we're probably in more of a double top situation for the dollar. As far as tariffs go, we talked about that already. I don't know. I don't think it's a beautiful word, but I just think in general, to kind of wrap up, there's too much euphoria about Trumponomics. I think there's
Hmm.
going to be. I think some of the policies will be great, but I don't think they're going to be as uniformly great as the market believes right now. So, yeah, I think you just in general want to be very careful with your capital allocation right now. If you like what you heard, then, go to Substack. You can find Haymaker there. That's really the best way. We've gone to a daily. I don't know if you know that, Adam, but we put out this very short daily that you can read in, 2 or 3 minutes. So we'd love to have your support there. We can skip that one. We know uh, that part of it, but we've got these huge trade deficits, an incredibly strong dollar, crazy. It's like so many things, so many crazy things out there. But you're not one of them, Adam. You are a voice of sanity and logical thinking at all times.
You are a voice of sanity, my friend. I'm just the vehicle. All right, Dave, this has been wonderful. When I edit this, I will put up the link on the screen to your Haymaker Substack. Highly
Thank you.
encourage folks to go sign up for that. Excellent, excellent publication. Um, and as you mentioned earlier, Dave, I love the fact that I'm kind of forgetting the terms you use. But you don't just give commentary, you very regularly say, hey, look, these are the assets that I think either have the best potential return potential or the ones that I would stay away from. And you keep it all in the boxing uh, terminology. So is it power punchers
Right.
versus the down and outs? Is
Down
that
and
am I
out. There
getting
you
it right?
go.
Yeah. Okay. So it's very friendly, but also very helpful to the individual investor who's looking for ideas to go out and consider as investments. And you do a very good job of saying, these are the ones you think are worth looking at versus these are the ones worth avoiding.
Thank you.
If folks are interested at all in learning more about Evergreen Gavekal, where should they go?
Well, our website's easy to find, and that is the mothership. That's really where my day job is at this late stage of my life. And so, yes, they also have regular publications as well, and got a team that's. I know you say this a lot with some of your other people that they'll do a free consultation. We call it a client compatibility survey. And frankly, this is just a fact. Most of the time, we suggest to people that they look at a different solution, whether it's an ETF or a mutual fund or something that we're not a good fit. We're definitely not a good fit for performance chasers and for do-it-yourself. Frankly, the do-it-yourselfers, you're better off looking at Haymaker. But if you're somebody that realizes, look, I need professional help, especially on the income side. You and I've talked about this. We even did a special presentation on this. It's so difficult to build income portfolios as an amateur. That's where I'd really recommend people look at a firm like Evergreen.
All right, fantastic. Well, look, David, riffing off this theme of changes, you've done a great job of illustrating for us the various winds of change that you see blowing with increasing intensity as we get further and further into 2025 from the start here. Sort of like what I think is the undertone of what you're saying is I'll be more overt. I think that if you are a regular retail investor, unless you have a very well defined track record of being a really successful DIY investor through good times and bad, this is probably a very good time to bring in the professionals, and that's either leveraging the thinking of a good professional through a publication like Haymaker, right? If you still want to be managing everything yourself, but tap some sort of expert that you can be looking over their shoulder, right, to be seeing what they're doing and let that inform your investing decisions. And I think this is relevant to really the vast majority of like the folks that watch this channel who have real lives, real jobs, real families, et cetera. It's try to find a financial quarterback who's got the experience and the perspective and the seasoning to kind of take the lead here and manage your assets for you while you're focusing on the things that you can do really well, like increasing your income or making sure you raise your family right? So if you really like David and his approach, highly recommend you go talk to the guys at Evergreen Gavekal. If you'd like another opinion as well, if you watch this channel a lot, you see the other financial advisors I have on here. Just go to thoughtfulmoney.com, fill out the short form, and you can get one of those free consultations that don't cost you anything. There's no commitment to work with them. It's just a free public service that they offer. So in fact, I would say talk to David's firm and any of these firms. I mean, it's getting multiple points of view that you can then determine what yourself to do with. There's no downside to it. But I'm a huge fan of David, of his team there at Evergreen Gavekal. I really can't compliment them enough. And David, you yourself, my friend, you're one of my favorite people to interview. You've proven that many times over in this interview here with your great work and just your expertise and your generosity in sharing it. So thanks so much, my friend.
Well, you're very welcome. I hope your viewers feel that way, Adam. Just a
I'm
little
sure they
bit. I
do.
mean, I mean, seriously, you have some of the greatest minds, most impressive financial intellects that are on your channel. And it's like, I feel like, what am I doing here? But I'm glad you think
No,
that there's at least some value.
David, you're selling yourself too short, and you are one of those people where when it's been too long since your last appearance, the emails start coming in. Hey, when is David
Really?
getting on the program? Absolutely, absolutely.
Oh,
So, folks, please show David that love by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. All right, David, look, really look forward to having you back on in Q2 if you're open to coming back on and giving us
of
an
course.
update in the second
Absolutely.
quarter. Okay, thank you very much. And yeah, just huge props to you and your team. Thank you so much. And to everybody else, thanks so much for watching.